Emerging markets represent countries with rapidly growing economies and developing financial systems. These markets often offer investors exciting opportunities for high returns due to faster economic growth compared to developed markets. Countries like India, Brazil, and Vietnam are examples where businesses and industries are expanding quickly. However, investing in emerging markets also comes with unique risks, such as political instability, currency fluctuations, and less market transparency. Understanding these benefits and risks is important before diving in. This guide will explore why emerging markets could be the next big investment opportunity and how to approach them wisely. In this video, we will talk about emerging markets, the next big investment opportunity. So make sure to watch the full video. 1. What are emerging markets? Defining the landscape. Emerging markets are nations experiencing rapid economic growth and industrialization, but they are not yet classified as developed economies. These countries often have improving infrastructure, expanding middle classes, and increasing consumer demand. Investors are attracted to emerging markets because of their potential for higher returns, driven by economic development and demographic trends. However, these markets tend to be more volatile and less regulated than developed markets. Knowing what qualifies as an emerging market and understanding its characteristics is the first step to smart investing in this area. Emerging markets can be found in regions such as Asia, Latin America, Eastern Europe, and Africa. Each market has unique features, growth drivers, and risks. Recognizing these differences helps investors build diversified portfolios that benefit from global growth while managing exposure to specific market risks. 2. Why are emerging markets growing fast? Key drivers. Emerging markets often grow faster than developed economies due to factors like urbanization, population growth, technological adoption, and improving education. Many emerging economies benefit from a young, growing workforce that fuels consumption and production. Government reforms and foreign investment also play a significant role in accelerating development. Additionally, rising incomes create new opportunities for consumer goods and services companies. 3. The benefits of investing in emerging markets. Investing in emerging markets offers potential for higher returns compared to developed markets because of rapid economic expansion. Diversifying your portfolio with emerging market assets can reduce risk by spreading investments across different regions and sectors. Additionally, many emerging markets have under-penetrated industries, meaning there's room for businesses to grow significantly. Exposure to these markets allows investors to capitalize on global growth trends and demographic shifts. 4. Risks involved in emerging market investments. Emerging markets come with several unique risks. Political instability, regulatory changes, and corruption can affect market performance. Currency fluctuations are common and can impact returns when converting profits back to your home currency. Market transparency and liquidity issues may make it harder to buy or sell assets quickly. Economic dependence on commodities or a single sector can increase vulnerability to global price swings. 5. Popular emerging market countries to watch in 2025. Countries like India, Vietnam, Brazil, and Indonesia continue to attract attention due to strong economic fundamentals and growth prospects. India's large and youthful population fuels consumption and technology innovation. Vietnam benefits from manufacturing and export growth as companies shift supply chains. Brazil's natural resources and improving business environment provide opportunities in energy and agriculture. Indonesia's growing middle class increases demand for consumer goods and infrastructure investment. 6. How to invest in emerging markets, stocks, ETFs, and mutual funds. There are multiple ways to access emerging markets, including buying individual stocks, investing in ETFs, exchange-traded funds, or mutual funds focused on these regions. ETFs and mutual funds offer diversification and professional management, which can reduce risks for beginners. Individual stocks may offer higher returns but require more research and monitoring. 7. The role of currency risk in emerging market investing. Currency fluctuations can significantly affect your returns from emerging markets. If the local currency weakens against your home currency, your investment gains may be reduced or wiped out when converted back. Conversely, a strengthening local currency can enhance returns. Currency risk could be managed through hedging strategies or by investing in funds that provide currency protection. Being aware of exchange rate trends and geopolitical factors influencing currencies is crucial for emerging market investors to avoid surprises and protect their capital. 8. Emerging markets and global economic trends. Emerging markets are deeply connected to global economic trends like commodity prices, trade policies, and technological innovation. For example, rising commodity prices can boost resource-rich emerging economies, while trade tensions might hurt export-driven markets. Advances in technology, such as mobile internet adoption, often happen faster in emerging markets, creating new business opportunities. Understanding these macroeconomic trends helps investors anticipate market movements and position their investments to benefit from global shifts. 9. Long-term versus short-term investing in emerging markets. Due to higher volatility and risk, emerging markets are often better suited for long-term investors who can withstand market ups and downs. Short-term investing in these markets can be unpredictable and risky because of political events or sudden economic changes. Long-term investment allows you to ride out volatility and benefit from sustained economic growth. Patience, combined with regular portfolio reviews and adjustments, increases the chances of success when investing in emerging markets. 10. How to build a balanced portfolio with emerging markets. Integrating emerging market investments into a diversified portfolio can improve overall returns and reduce risk. A balanced portfolio mixes developed and emerging markets, various sectors, and asset types such as stocks and bonds. The right allocation depends on your risk tolerance and investment horizon. Regularly reviewing your portfolio and rebalancing helps maintain your desired risk level while capturing growth opportunities in emerging markets. Working with financial advisors or using managed funds can also help beginners navigate these complex markets effectively. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.